On paper, building wealth in the stock market sounds pretty straightforward. So why is it so incredibly hard in real life? Well, it turns out the biggest hurdle isn't financial at all. It's psychological. Today, we're going to dive into some key insights from Parag Parikh's Stocks to Riches to really understand the mind of a successful investor. So let's just kick things off with a pretty staggering number from the book. A full 90% of investors failed to beat the market over the long term. Think about that. That means 9 out of 10 people trying to grow their money in stocks would have actually been better off just buying a simple, boring index fund. So what's the deal? Is the market just this impossibly complex beast, or is it rigged? Well, according to Parag Parikh, the answer is a big no. The biggest obstacle standing between you and your financial goals isn't some trader on Wall Street. It's actually the 6 inches between your own 2 ears. Okay, so let's talk about our brains. They evolved for survival out on the savannah, not for navigating the ups and downs of the S&P 500. And that ancient wiring, well, it creates these hidden biases, these mental shortcuts that were awesome for escaping predators, but can be an absolute disaster for your portfolio. Let's break down some of the biggest culprits. First up is the heavyweight champion of all biases, loss aversion. Researchers have found that the pain of losing, say, $100 is about twice as powerful as the joy you feel from gaining that same amount. This crazy fear of taking a loss can push us to make some deeply irrational decisions with our money. And right on its heels is its dangerous cousin, the sunk cost fallacy. You know that little voice in your head, the one that says, "Ugh, I can't sell now, I've already lost so much. I'll just wait for it to recover." That's the one. You're making a decision based on money that's already gone, not on where the investment is headed tomorrow. It's a classic trap. So what's the actual real-world damage from all these mental gymnastics? Well, it looks a lot like this. Loss aversion makes you sell your winning stocks way too early, just to lock in that tiny bit of profit and stop the anxiety. Then, the sunk cost fallacy makes you hold on to your losers for dear life, hoping and praying they'll come back to even. Put them together, and you get a portfolio built on fear and false hope instead of a solid strategy. Okay, so how do we fight back against our own brains? It all starts with making a really fundamental choice. You have to decide right now who you are in the market. Are you an investor or are you a speculator? Because believe me, the difference is everything. And the distinction is just crystal clear. An investor, they're buying a piece of a real business, focusing on its ability to make actual money. A speculator, on the other hand, is just betting on which way the price is going to move. They're playing the ticker, not owning the company. One of these paths builds long-term sustainable wealth. The other, well, it very often leads to getting wiped out. This brings us to a really core principle of building wealth. An investor's job is simple: acquire assets. These are things that put money in your pocket through things like profits and dividends. A speculator, more often than not, ends up with liabilities, those hot stocks that only seem to take money out of your pocket. Okay, so once you've got that investor mindset locked in, you need a playbook. And I'm not talking about some super complex algorithm. We're talking about a set of simple, repeatable strategies that are designed to keep your emotions on the sidelines and your portfolio moving in the right direction. Let's look at a couple of key ones from the book. Strategy number 1 is the one made famous by the man himself, Warren Buffett. Buy and hold. The idea is so simple. You find great companies, ones with strong businesses and good managers, you buy them at a fair price, and then you do pretty much nothing. You just hold on for the long haul and let the business do the heavy lifting for you. You only sell if the whole reason you bought it in the first place totally changes. The second strategy is a little more tactical. Parikh calls it the profit pyramid. And it's a really simple rule to fight off both greed and fear. It goes like this. When a stock you own goes up by 25%, you sell 25% of your shares. That's it. This locks in some of your profit, gives you some cash to work with, but still lets you keep riding that winning horse. It's just a disciplined way to handle success. And finally, of course, your strategy has to grow and change as you do. When you're young, you've got decades ahead of you, so you can afford to be more aggressive and have more in stocks. But as you get older and closer to retirement, you naturally start to shift gears, moving toward a more balanced, conservative portfolio to protect the nest egg you've worked so hard to build. So, we've got the mindset, we've got a few solid strategies, but none of it, and I mean none of it, works without discipline. This last part is a simple checklist. These are the non-negotiable rules that really separate that successful 10% from everybody else. You should think of these rules as your guardrails. Only invest money you can truly afford to lose. Never, ever borrow money to buy stocks. Spread your bets, diversify, do your homework, and actually know the businesses you own. And maybe most importantly, you need to schedule regular checkups on yourself. Acknowledge the biases we just talked about and actively look to see if they're creeping into your choices. This is how you stay the course. And that really brings us right back to the core message of all this. The strategies for building wealth: buy good companies, hold them, take some profits, diversify. None of this is rocket science. The methods themselves are simple. The true challenge of investing isn't mastering the market, it's mastering yourself. So the real question is, can you?